In the last 2 to 3 years, we have seen many companies whose share price have skyrocketed, with some even multiplying several times. Among these wealth creators, railway stocks have become a favorite stock for retail investors. So today, as part of our A to Z stock analysis, we are going to discuss about the IRFC, which is one of the most popular railway stock. IRFC was trading at 70 rupees back then in September 2023, and it reached to the highs of 200, and now it is trading in the range of 160 to 170. But you know what's the interesting point here? Many people who have invested in the company don't fully understand what IRFC is about. So in this deep dive, we are going to analyze everything that you need to know about IRFC, coming from its business model, strengths, risks, financials, and growth triggers. So without any further delay, let's get into the video. IRFC, short for Indian Railway Finance Corporation, is a Government of India undertaking working under the Ministry of Railways. It plays a critical role in funding the Indian Railways. Founded on 12th December 1986, the primary function of IRFC is to raise funds from domestic and overseas market. And another important function of the IRFC is to cover the extra budgetary requirements of Indian Railways. Since its inception, IRFC has funded the acquisition of 13,349 locomotives, 73,979 passenger coaches, and 2,59,661 freight wagons. As of FY21 to 2022, IRFC has provided over 5.5 lakh crore in cumulative funding to the Indian railway sector. So with that brief introduction, let's get into the industry, and before that, we need to understand few terms related to the industry. First term, rolling stock. Rolling stock refers to all the vehicles that move on the railway tracks. They may be powered or unpowered. It covers everything from passenger coaches and freight wagons to materials vehicles, and all of them together helps in the functioning of railway system. Moving to the second important term, which is cost plus agreement. In this leasing model, the party leasing the asset agrees to pay the asset owner the actual cost of the asset along with an additional fee. This fee is designed to cover the owner's overhead, profit margin, and other related costs. These are the two important terms which we need to know. Now let's move on to the business overview of the company. IRFC has three main business functions. First one, leasing operations. IRFC primarily finances the acquisition of rolling stock and project assets for Indian Railways through a leasing model. The typical lease period is about 30 years, and it is divided into two ways, primary and secondary terms. During the primary period, the interest and the principal amount are recovered through the lease agreement. Once the secondary term concludes, the project assets are transferred to the Ministry of Railways for a nominal value. The leasing agreement with the Ministry of Railways follows a cost plus structure which ensures the stability in earnings and profitability for IRFC. Now let's move on to the second important operations of the IRFC, which is lending operations. The company extends loans for various entities within the railway sector. That includes Railway Vikas Nigam Limited, Railtel Corporation of India, Konkan Railway Corporation, and PRCL. These lending activities support the funding of key railway projects, infrastructure development, and capacity enhancement initiatives. Now let's move on to the third important operation, which is borrowing operations. To meet its funding requirements and provide loans, IRFC taps into a variety of sources for raising capital. These include tax-exempt bonds, 54 EC bonds, securing term loans from banks and financial institutions, utilizing commercial papers, and accessing external commercial borrowing. So before getting into the internals of the company, let's talk about the industry overview. India has the fourth largest railway system globally after US, Russia, and China. Indian Railways is committed to build world-class infrastructure at sustainable costs, and it is integrating cutting-edge technologies into its vision for the future. As part of the Amrit Kal period, the Indian Railways envisions a major transformation by 2047. This ambitious plan includes developing 7,000 kilometers of high-speed rail lines carrying 10 million passengers annually, expanding freight corridors to 7,800 kilometers, constructing elevated corridors spanning 10,000 kilometers, and also introducing Vande Bharat trains connecting all major cities and establishing over 1,500 Gati Shakti cargo terminals. In terms of freight, Indian Railways achieved a total loading increase that translated into revenue of 1.72 lakh crores, which is higher than the previous year. Indian Railways is steadily advancing towards the milestone of 1 trillion net ton kilometers, and it is making significant step towards energy efficient transportation systems. Now let's talk about the strengths of the company. First strength of the company, strategic importance and government support. IRFC holds immense value as the sole financing arm of the Indian Railways, and it is also backed by the Government of India, which holds 86.36% stake in the company. The direct involvement of Government of India gives the extra credibility and stability of the company. Second strength of the company, zero non-performing assets. One of the most remarkable achievements of IRFC is zero NPA, which means no loans or advances have gone unpaid for an extended period. This is a vital indicator for the company's financial health. To understand how critical NPA is for the financial institution, please check out our S-Bank video in which we explain how S-Bank has got into the crisis because of the rise in the NPAs. Since IRFC lends only to the Indian Railways, this risk is mitigated, ensuring financial stability and profitability. Third important strength of the company, cost plus model. We already discussed the cost plus model in the beginning of the video, but now let's get into the detail of it. IRFC operates under a cost plus model which funds the acquisition of rolling stock and project assets such as locomotives, coaches, and infrastructure projects. The costs incurred by the IRFC includes the purchase price of the assets, administrative expenses, and any other relevant costs. IRFC then charges the Indian Railways for these assets based on the total cost incurred plus a fixed margin or fee. This margin covers IRFC profit and administrative costs. The cost plus model provides the stable and predictable revenue model for the IRFC. Since the fees is based on the cost plus the additional margin for the IRFC, it ensures the stable and predictable revenue of the IRFC. So, IRFC can earn a profit without the risk of underpricing or unforeseen costs. The lease rentals with Indian Railways are fixed at the average cost of borrowings plus 40 to 35 BPS. Now let's move to the last strength of the company, which is diversified borrowing profile. As of March 31st, 2024, IRFC's total borrowing stood at 4.12 lakh crores, a reduction from 4.18 lakh crores from the previous year. This decrease was driven by repayments from profits with no new borrowings during the period. The breakdown of these borrowings is as follows. Domestic bonds contribute 48% of the borrowings. Rupee term loans contributes 30.4%. Foreign or external commercial borrowings contributes 16.7%. National small savings contributes 4.3% and short-term loans contribute 0.6%. If it is clear, let's move on to the risks of the company. First risk of the company, high concentration risk. One of the IRFC's most challenging risks is its high concentration. The company's entire loan portfolio is tied with the Ministry of Railways and related entities. As of March 31st, 2024, IRFC's distribution of loans and advances was 56% in lease receivables from Ministry of Railways, 43% related to the leasing of railway infrastructure assets, and the remaining 1% to Rail Vikas Nigam Limited. While this concentration makes it special, it also increases the dependency on the Ministry of Railways. If there are any changes in the development plans of Ministry of Railways, it will clearly impact the IRFC's business and its revenues. Next important risk is shift in budgetary support. A significant shift in the funding possesses another risk of the company. For IRFC, with assets under management as of 31st March 2023, totaling 4.6 lakh crores, which are tied to the Indian Railways of about 98.94%. Which means the company is heavily dependent upon the Indian Railways. However, in the recent years, Indian Railways has shifted towards the budgetary allocations rather than the extra budgetary requirements from IRFC. As Umar Anade, Chairman and Managing Director of IRFC pointed out, this transition began in FY21 to 2022 with Indian Railways receiving substantial budgetary support. In FY24, there was no additional funding required from IRFC, which could impact its growth trajectory if budgetary support remains strong. And there are some limited exposures to the market risk. While most financial institutions face problems such as market risk, credit risk, and several other common risks, IRFC has some kind of edge compared to the other financial institutions, as it is the sole lender for the Indian Railways. And also the fixed margin, which means a cost plus structure of the IRFC, enables its stable and predictable revenue stream of the company. Now it is time for us to get into the financials of the company. First, let's focus on the sales growth of the company. Sales for IRFC have shown impressive growth over the years, rising from 9,047 crores in March 2017 to 26,645 crores in March 2024. This substantial increase reflects strong revenue growth and an expanding business footprint. Moving to the expense trends. While expenses have increased from 26 crores in March 2017 to 133 crores in March 2024. This rise is relatively moderate compared to the growth in the sales. Moving to the third point, which is net profit growth. Net profit has surged from 934 crore in March 2017 to 6,412 crore in March 2024, which highlights the significant improvement in the company's financial health and stability. But there are some key metrics which we need to discuss in the financial sections. First one is debtor days. IRFC's debtor days have remained relatively stable with figures of 3,609 days in March 2022, 3,744 days in March 2023, and 3,557 days in March 2024. Debtor days indicates the average time it took for the company to collect its payments from the customers. For financial institutions, high debtor days can impact the cash flow of the company, and it also impacts the financial performance of the company. Second important metric, capital adequacy ratio. The capital adequacy ratio for IRFC has shown a notable improvement, rising from 484.9 in 2023 to 616.2 in 2024. Now let's move on to the third important metric, which is price to book value ratio. Most of us, while analyzing any company, will look at the PE ratio. But whenever we are analyzing the financial institution or any bank, we need to consider price to book value, because it talks about the assets that the company have. On September 2, 2024, IRFC share price was 172 rupees, but the book value of the IRFC is 38.8 and the stock is trading at over 4 times of its book value. Now let's talk about the shareholding pattern of the company. The promoters have kept a strong 86.36% stake and are firmly in control of the operations. However, investment from foreign and domestic institutions have decreased, with FAS dropping to 1.08% and DAS to 0.89%. Whereas public shareholding has increased from 7.97% to 11.68%, and the number of shareholders has grown from 13.5 lakh to 51 lakh. So this indicates the interest from the retail investors. Overall, strong promoter control and rising public interest is a good sign of the company. We discussed everything about the company, from its strengths, risks, financials, and shareholding pattern. But the company's future is dependent upon several other factors, and we call it as growth triggers of the company. So let's start with growth triggers of the company. First point, growth of railways. The railway passenger traffic is projected to reach around 12 billion per year by 2031, and freight traffic is expected to cross 8,220 million tons by 2031. Dedicated freight corridors are being constructed, which will have huge funding requirements in the future. And new lane conversion of 5,243 kilometers has been achieved during 2022 to 2023, as against 2,909 kilometers in 2021 to 2022. The average daily track length in FY23 translates to 14.4 km per day, which is the highest ever commissioning. And the second growth trigger of the company is diversifying business portfolio. As we already know, the company is the sole financier of the Indian Railways, but the company is now trying to diversify its business portfolio. It is very important for the company because it will drive its growth and also the revenues of the company. Umar Anade, Chairman and Managing Director of IRFC, highlighted in the May 2024 Concall report that IRFC is actively exploring diverse business opportunities beyond its traditional role of leasing rolling stock to the Ministry of Railways. The company plans to fund the entities which are having backward and forward integration to the Indian Railways, that including rolling stock to other parties and financing railway infrastructure through state joint ventures. Additionally, IRFC is looking into multimodal logistic parks and renewable energy projects for the railway network. With the Indian government's strong focus on the infrastructure development of the railways, these initiatives present significant growth potential of the IRFC. Now let's discuss the last section of the video, which is ESG. ESG stands for Environmental Social Governance. So first section, environmental. According to its annual report, the company mentioned that they are financing the green initiatives of the Indian Railways from the transition from conventional locomotives to electrical locomotives, and also supporting the electrification of the railway tracks. Indian Railways is working on a mission mode to become the largest green railways in the world and is moving to become a net zero emitter by 2030. Under the green initiative of Indian Railways, it is planning to invest sizably by the way of massive electrification of railway tracks, replacing diesel locomotives with electrical locomotives, introducing 100% LED lights and high star rate appliances, undertaking energy audits and implementing smart metering. Indian Railways is also planning to set up a solar park, rooftop solar both for coaches as well as railway buildings, solar pumps, solar streetlights, and solar water heaters. IRFC has adopted a green financing framework and it raised $500 million through green bonds and $1.1 billion through JPY denominated green loans in fiscal year 2022. Now let's move on to the second section, which is social. The overall required CSR funding for FY24 is 112.27 crores and the company has sanctioned the whole required amount for the CSR activities. But now let's do the breakdown of the CSR funding. 22.23 crores for the contribution to PM Care Fund, 4.5 crores to Swachh Bharat Kosh, 4.5 crores to Clean Ganga Fund, and 80.94 crores to the other approved projects. Moving to the last point, which is governance. The company's governance structure is characterized by approximately 33% of its board comprising of independent directors, approximately 50% of the directors are women, and a lack of split in the positions of chairperson and CEO. But there are some allegations of the officials of the IRFC. The CBI has filed a case against Amitabh Banerjee, the former chairman and managing director of IRFC, for mishandling funds by purchasing gold coins and gifts at inflated prices. The investigation started by Railway Vigilance uncovered issues with how these gifts were brought and distributed. Both Banerjee and IRFC officials couldn't provide a list of who received the gifts, and there was no clear procedure for these purchases. So this is about the governance of the company. IRFC's strong support from the government, its unique cost-plus structure model, and also the consistent financial performance of the company make it a resilient player in the financial sector. But the future of the company is dependent upon the upcoming projects and the funding requirements of the Indian Railways. As we discussed all the parameters from its strength, risks and growth triggers, investors must keenly observe the funding requirements from the railways and also the future projects of the Indian Railways, because it will completely impact the overall financial performance of the company. So while making any investment decisions, you should follow all these parameters and keenly observe all the other parameters of the company. So that's a wrap for our deep dive into IRFC. We'll catch you with another video in the next week. Till then, please share and subscribe to our YouTube channel. If you found this video helpful, please share this video to your investor friends. Thank you. Thank you for watching the video.